Good morning, guys, and welcome to the show. Listen, glad to have you guys here. Now, we want to get started right away because I got a lot of stuff to talk about, so I'm going to open up the charts right here. And the first thing I'm going to talk about is the Fed Reserve. In this article, it says, Powell says, no rush to hike rates in a solid but slowing economy. And what I want to point out is the fact that the economy is slowing down. It's slowing down immensely. And they know this. This is why the Fed's backed up. Well, they haven't really backed off the pedal, but what they've actually done is they've said they're going to back off the pedal, and this has had a profound effect upon the markets so far. Anyway, I want to show you guys something that's really important here, and it's this chart. This chart's extremely important, and I'm going to explain this chart first to you. This chart goes from the year 1950 all the way up to the present day, and don't pay attention to the little red and green lines. Don't look at those. What I want you to focus on is the gray bars that run from the top of the chart to the bottom of the chart. Those bars are recessions. And what you notice here is the other thing I want you to focus on this chart is the gray squiggly line in the center of this chart that goes up and down. That's the unemployment rate. Now, this is probably one of the biggest indicators. This particular chart is one of the biggest indicators of a recession that you can get out there. And what you notice is that the unemployment rate on this chart always dips just before a recession. It dips down to its lowest point. Now, the second thing I want you to notice is the spread between recessions. And this is a very important indicator. So there's two indicators on this chart. One is the low unemployment rate just before a recession and the spread between recessions. Going all the way back to 1950, you can see the spread between recessions is the widest spread. Like from 1960 here on this chart, look down and see 1960 to 1970. You see a wide spread between recessions. The gray bars is the recessions. And that was like a 10-year spread. That's a wide spread. Notice that one wide spread there? And there's another wide spread here between 1990 and the year 2000. So we get two wide spreads. But also, there's generally, oftentimes, there's only 5 or 10 years, or 5 to 7 years. And sometimes recessions come really close. Like in 1980, we had a small recession, and then it led right into another one within a year or two. There's two gray bars that are really close together there in 1980. And there's also, back around 1960, there's a couple bars that are really close. We had a series of recessions. We had 3 of them there. And they come fairly close together. But generally speaking, a wide spread between recessions might be 12 years. Take a look between 1990 and 2000. We must have had about 11 years there between recessions, and that's a wide spread. So what do we notice now? We come to the very right of the chart, and we notice between the last recession was what they call the Great Recession. When we had the 2008 event, Lehman Brothers and all of that. Look at the wide spread between that and where we are now. We got a wide spread there, guys. That's a big indicator that we're ready to start a recession. And when you factor in the low unemployment rate, which is a second huge indicator, and you go back and take a look at what Fed Chairman Powell is saying here, no rush. You know why they backed off? They backed off because we're starting to enter into the front side of a recession. He says slowing economy. Slowing economy is the leading indicator you're going into a recession, and they're admitting it. So we're heading into a recession right now. How long is it going to take before they finally admit we're in a recession with 2 quarters of down GDP, that's coming. But, before they finally admit we're in a recession, we'll already be in a recession. I think the recession is beginning. It's actually getting going. And look, there's several things that could push us right into a recession. Deutsche Bank, first off, they can control that. The Brexit, they can control that. The Italian debt crisis, they can control that. But China, they can't control that. It's too big. China could push us into a recession faster, and faster than waiting for two negative GDP quarters, because that takes a half a year. China could push us into a recession in a few weeks if really bad numbers start coming out of China. And so we got to keep our eye on that. Now let's move on here. We've taken a look at that. Let's move on here and take a look at the markets today. We see silver is right in its range today. It's at $15.83. Let's take a look at gold. Gold is in its range too, and they're both trending upwards slightly. Gold is at $1,326.80 today. Now let's take a look at Bitcoin. Bitcoin is at 3808, and I'm going to tell you something. We had that little fall in Bitcoin. Probably a whale was dumping some coins. We were up to $4,190, but what I noticed, the biggest thing I notice is Bitcoin has been trending upwards, and even since this fall now, it's been trending upwards. I'm getting bullish signals from Bitcoin. Even though we're at the bottom of a long bear market, I'm getting bullish signals that are coming from it. Let's take a look at cryptocurrency market capitalizations. $130.5 billion. Bitcoin dominance of 51.9%. And we're seeing the coins start to trend upwards. Litecoin is at $45.65. Ripple, XRP, is at 31.8 cents. Ethereum is at $139. EOS is at $3.50 each. What a nice time to buy EOS, only $3.50 each. That's my opinion only. That's not financial advice. Anyway, let's take a look at crude oil. Crude oil today is slowly trending upwards, and it has been. It's up 92 cents on the day, 1.66%. That's actually not so slow. That's a pretty good little jump in price, $56.42. Now let's take a look at the Dow. The Dow, according to the futures, is down 85.98 points today at 26,050. We'll have to wait until the Dow opens up full to find out what it's actually going to do, but it's indicating, its leading indicator is that it's going to open up down a little bit today. Let's take a look at the U.S. bond market right now, and we're seeing falling rates all except for the long bond. And the long bond hasn't risen that much. The short end is unchanged. So we're looking at 2.63% on the U.S. 10-year and 3.01% on the U.S. 30-year. Now let's take a look at the dollar. The dollar is probably the biggest mover and shaker today. The dollar's falling. We're looking at 95.90. So it's broken down below 96, the U.S. dollar, and we got a falling dollar today. You know, the Fed has not changed their policies. They're continuing on the course. They only said they were going to be patient. That's like a guy who says to a little fat kid, you know, little fat kid's getting ready to take a ride down the big slide, you know, at the water park, and he's sitting at the top, and the guy that's going to give him the push to push him down the water slide says, "Be patient," you know. But he still intends to push him down the slide. Well, that's the way with the Fed, you know. They still intend to do what they want to do. They're just saying, well, we're going to be patient, but we're still going to raise rates if we can get away with it. This is basically what's going on right now with this. But I'm going to tell you what, when we enter into this next recession, the Fed's going to have to back off the pedal, and it's very likely they're going to have to lower interest rates down to zero, and they might even, if it's a bad recession, which is in all indicators is it's going to be a very bad recession, worse than 2008, they're going to have to go into negative rates, negative real interest rates. And what does that mean for you guys? It means they're going to try to get rid of cash as fast as they possibly can. Basically, that's what it means. Cash is going to become a pariah to the financial system because they do not want you to be able to take your money out of the bank because they're going to be charging you to keep your money in the bank with negative real rates. I mean, this is crazy. Okay. Okay, let's move on here and let's take a look. The Baltic Dry Index today. What we're looking at is 649 on the Baltic Dry. She's up a little bit. You know, she dipped down to around 600. Now she's back up to 649, but still, that's extremely low. And this is an indicator, again, of China's problems. China's got huge problems. I need to do more shows on China because this is where the next recession's probably going to actually get its start. But, you know, they won't declare it a recession. Even if we go into a profoundly bad recession, they don't declare it until we get 2 negative quarters, which takes 6 months. So we could be in a recession for 4 whole months, and they're still waiting to declare it, you know. I mean, I suppose if it's bad enough, they have to admit it. Hey, you know what, we're in a recession because everything's collapsing. You know, I mean, come on. Okay, let's take a look at Deutsche Bank here. 7.81 on Deutsche Bank. So we're keeping an eye on Deutsche Bank here. What we see is if we go to the 6-month chart, we can see they're doing a pretty good job of surviving. They went down to 6.75 euros on December. It really looked bad, you know. But now what they're doing is they've been bottom bouncing or bottom feeding. And they're at 7.83 or 7.81 this morning, but they are falling today. We got to keep an eye on Deutsche Bank, you know, from now and into the future. Listen, thank you guys for listening. Like and subscribe, and we'll catch you in the next show, guys. Bye-bye.